Yeah, this just happened. Silver sitting at $87 after touching all-time high. And guess what? The CME, yeah, they did something again, the shady stuff. I'm coming to that in a second. Gold, silver hit record highs as inflation data cements Fed rate cuts bet. Even Bitcoin is not bad. It's sitting at 93,000. And then I hear BlackRock, they started moving their coins to Coinbase Prime. Why would they move it to exchanges? Well, I'm sure you're smart, you know, right? So this is silver right now. Now, let me just read a few things just to make sense. CME just raised margins again. This is not normal. The CME group just changed gold and silver margins from fixed dollars to a percentage of notional value. Gold equal to 5%, silver equal 9%. Translation: the higher gold and silver go, the more collateral shorts must post. That means shorting metals just got way more expensive. Over-leveraged paper traders get squeezed faster, like squashed. Forced covering equal to higher volatility. CME raises margins when the market is under stress, not when it's calm. Paper shorts feel the pain. Physical holders get confirmation. This isn't bearish. This pressure building. Know what you hold. This is the paper right there. You can see that, the clearing. Okay? Effective Jan 13th. Latest. Wait for silver 85% next month. I think it's the opposite. This applies to the long. To the short, banks don't care about the money spending. They have unlimited credit. And these are some of the points of views. All right? I'm just reading. Whoa, the CME raised margins again. This is not normal. Yep, I know. Here's another one. CME Group to launch 100-ounce silver futures to meet record retail demand. Something is cooking real hard. Understand what's cooking. Forget about the price here. Launching a smaller contract size usually signals sustained retail participation rather than a short-term spike, especially when it follows new price highs. Bro, CME are scammers trying to make us gamble instead of giving physical silver. What do you want? We want physical silver, real delivery, transparent inventory, exit paper system. But what they're giving us and offering, leverage futures, gaming the contracts, margin gambling, printer paper door. Not surprised. They just handed the retail crowd a megaphone. The standard 5-ounce contract was a barrier to entry. The new 100-ounce contract is an invitation. CME is effectively democratizing leverage for the silver squeeze. Expect volatility to explode. Yeah. Again, CME Group to launch 100-ounce. I just read that. And these are just some of the confirmation that this is actually happening. At the precipice. Guys, you guys use some crazy AI words, man. Just dumb it down. Look, even people are using Grok to explain, like 8-year-old child. Just use it so people don't have to use Grok. It's sitting at $91. American Eagle. Uncirculated 2024 $91 on US Mint. Yeah, this is 1 hour ago. It's true. And a 2026 mints, they just got sold out. Just after getting out, they got sold out. No more available at this moment. I'm just going to read one more, all right? Silver is not rising because of speculation. It's rising because the paper market is structurally short against real metal. And that's why CME margin hikes work the opposite way most expect. Here's the mechanism step by step. What margin hikes are designed to stop. CME margin increases are meant to slow leverage-driven rallies. Too many paper longs, too many board money, and too little skin in the game. In that environment, higher margins force liquidation, price cools. That logic only works when the rally is optional. Number 2, silver's problem is not leverage, it's obligation. In silver, a large share of shorts are structural. Bullion banks, producers, hedgers. They're short because they promised a metal. They have promised a metal, okay? Their risk is not mark to market, it's delivery. But if there's no supply, then how can they even get the delivery? Understand what's happening. This means longs can leave, shorts cannot. What a margin, yeah, because you're getting short squeezed. What a margin hike actually changes, a margin hike does not reduce delivery commitments, create new metal. Oh, it does not create new metal, eliminate physical demand. It does increase daily cash required per contract, raise the cost of rolling shorts. Yeah, because it's increasing cash, so more people, they're short, basically. Raise the cost of rolling shorts forward, tighten internal risk and liquidity limits. This attacks time, not price. They're buying time. Time compression on shorts, the core. Before the hike, shorts can roll positions, wait for longs to give up, absorb manageable daily cash bleed. After the hike, cash drain accelerates, rolling becomes punitive, risk desks shorten tolerance windows, trade lines come under stress. Banks are panic mode, in simple terms. In other way to say it, there's a bank run going on. The same position that could survive weeks now survives days. That's time compression. Why this accelerates the squeeze? As time shrinks, shorts stop optimizing price, they optimize survival. They buy back earlier, they accept worse prices. At the same time, speculative longs, yeah, you see this here? Let me read this again. As time shrinks, shorts stop optimizing price, they optimize survival. Because now, if you don't close short and it keeps going up, what do? You close at a loss, right? They buy back earlier, they accept worse prices. Speculative longs exiting reduces liquidity. Bullion banks step back from market making. Paper supply thins. Physical premiums stay firm. Result: less selling, more urgency, higher bids. Number 6, where producers matter most. Producers hedge by shorting futures against future output. They don't sit on trading liquidity, their cash is tied to operations. When margins rise, variation margin spikes, daily cash calls increase, hedging becomes unsustainable, so they are forced to reduce hedges, buy back shorts, or delay hedging entirely. That turns a natural seller into a forced buyer. They're talking about producers, miners, and stuff. They'll probably take a hit based on this. All right? Futures and physical decouple. As stress builds, futures liquidity deteriorates, OTC, which is over the counter and bilateral settlement grows, physical premiums rise, backwardation appears. Margins don't stop the move. They push price discovery away from paper. Final truth the line most miss. Margins kill leverage, not scarcity. When silver rises due to structural shortage, people need to also understand that there's a physical demand for this. It's not just paper money or a random crypto token or meme token or any random stock. This thing has, first of all, a lot of manipulation, plus it has a lot of industrial demand, from chips to EVs to robots to drones, just name it, right? That's why silver keeps moving through tighter margins and why this is not a speculative rally. CME Group new margin rules. Look at this. The new margin rules are going to impact producers the most. So actually, they may be forced to buy back their hedging shorts. In other words, bullish. Most experts completely miss the point. Can this be a problem? Bullish for gold till something breaks. So I'm not gonna right now, talk about what you should buy, sell, whatever. I just wanted to present this to you in the most informational and educational possible way, so we can understand what's happening, right? Just see how they're moving and how quick they're moving. All right. I'll see you in the next one. Bye for now.